Margaret, move forward. I'm trying to get more people to the front. We're going to go ahead and get started this morning. I think we've got some folks probably still stuck in traffic, but we're so glad you're here for our healthcare helpings this morning. And our speakers this morning will be Nancy Mullen. He's a senior manager in the audit area and specializes in ERISA audits. And Kara Allen, who is...
Kara Allen.
And Kara Aaron. We do have a Kara Allen, so I'm not that crazy. Kara Aaron, who is our senior manager in the healthcare area and also specializes in ERISA audits. So I'll turn this presentation over to them. And we're a very small, intimate group this morning, so feel free if you have any questions to chime in during the presentation. Just let me get to you with a mic because we are recording this.
All right, let's try this again.
All right. Are we good?
I think we're good. All right, so we're going to cover plan oversight. What does compliance mean and why does it matter? And then we're going to go over some common compliance pitfalls, errors that we see a lot when we do our audits, and how to correct those pitfalls. So this is a list of organizations or groups of people that actually have oversight over a plan. The first is ERISA. The other is the Department of Labor, or EBSA, and the Internal Revenue Service. And the Department of Labor or the Internal Revenue Service could come in and audit your plan at any time. You also have plan trustees and a plan administrator, and they're the ones that are going to actually be responsible for your plan, making the decisions about your plan. The plan participants are going to want to make sure that their money is where it's supposed to be and that it's safeguarded. And also, you could have an independent auditor if your plan qualifies for an audit. So if your plan has over 100 eligible participants at the beginning of the plan year, then your plan is required to have an audit. So then that's when the independent auditors come in and they kind of take a deep dive into your plan to make sure everything's in compliance. And then if you are a public company and your company offers the public company stock as an option to your participants, you could also be subject to SEC or PCAOB oversight. When we talk about compliance, we're actually looking at two areas. First is the document compliance, and the other is operational compliance. And why is it important? Well, if you're not in compliance, your plan is not in compliance, you could be subject to fines and penalties, and those are typically going to be paid by the employer. Lawsuits, there's been several lawsuits recently. It makes a lot of it becomes public knowledge, and then you have negative publicity for your company. The DOL and the IRS might come in and audit it, and you want to be in compliance because you'd rather find the errors and correct them rather than have an audit and they come in and find them and give you penalties. And then you want to make sure that your plan doesn't lose its tax qualification. So it's pretty rare that they will come in and disqualify your plan, but they can do it and have done it. And that if your plan becomes disqualified, then you no longer have everything becomes taxable. It's no longer tax-exempt money that's in the plan. And then you might have a fiduciary breach. So if you are the plan trustee or administrator, you're responsible. You have fiduciary responsibility to make sure your plan's running correctly. So you might have a breach there. So when we talk about the plan document compliance, we're going to look at the plan document, which is the legal document that governs your plan. It's going to give you all the details about your plan, like who can be in it, what type of contributions, employer, employee, what the percentages are, your distributions, if you're going to have loans. So all the details about your plan are going to be in your plan document. And that's going to govern how it operates. So you could also have tax laws that come out every often, and there are some that affect the plan. They're going to require that the plan adopt certain things. So if you aren't up to date on these tax laws and your plan's not been updated, then you have a plan compliance issue. And then there might be some content that there's sometimes you've seen like where it kind of contradicts each other, or there's things that should be in the plan that, say you acquired a company and you want to give those employees a prior service credit, but you have to amend the plan. You have to make sure that the names of those companies are in that plan. So when we talk about operational compliance, where your failures are going to be is when you're not following your plan. So you've got this official plan document and you're not operating your plan the way you've written it to operate. Sometimes it's been inadvertently changed or amended, and then you're not in compliance with that amendment. So we had a situation one year where the plan had gone in and decided that they're going to cut out participant loans. So if you had a loan, you can keep paying it. But from this point on, no one else can take out a loan. And we get into the client, and it was October 1st, the cutoff. After that, no more loans. We go in to do the audit, and I'm like, someone took out a loan in November. Like, you made this amendment, and now you're not following your amendment. If there's a tax law change and you're not following that, that could be another operational compliance issue. Also, there's a summary plan description or summary plan document. And what that is, it's kind of a simpler version of your plan document. And this is typically what you give to your participants, so it's very easy to read, very easy to understand, so they can see what their plan, all the features in their plan. And sometimes there's been occasions where the plan document and the summary plan description might have differences. So you want to make sure that those are the same, because the summary plan description is what the participants usually get.
So I'm going to talk to us a little bit about some of the things that can go wrong. As Kara mentioned, you have a plan document, and that's what governs your plan. So I guess the first step is to make sure you actually have your plan document. You have the plan document. If you have an adoption agreement, you have that. You have all the related amendments, and that you understand them, or you ask somebody to understand them or help you to understand those. It's pretty hard to follow if you don't have it. It's pretty hard to follow if you don't understand it. And I've seen some just crazy documents that, it's taken 4 of us looking at it saying, I still am not quite sure what this says. You get a couple attorneys involved, and it's always fun. So just kind of keep that in mind and make sure that you have those. So as Kara mentioned, the plan document will tell you what your definition of compensation is. So that could be W-2 earnings, it could be gross compensation, it could be a few other things that could trip you up. And just because your plan operates one way doesn't mean that you go to the next employer and it's going to operate the same way. So you need to make sure that you understand the provisions that operate or that govern your plan specifically. Inaccurate compensation, I will say this is probably the biggest thing that we find problems with. Just coming into plans that haven't been audited, or even some that have, and just misinterpreting what's happening there with the compensation. Also, what can happen is your compensation can be limited or cannot be limited appropriately, with wage limits, and we'll talk about testing here in a minute. So one thing with compensation is you are able to exclude certain different types of compensation if you choose. You just need to make sure that whatever your plan document says that you've included or excluded, that you're actually operating it that way. We see this for bonuses. Sometimes people want to exclude bonuses from their compensation definition, and that's appropriate to do. Severance per pay is another one. A lot of what you use your 401k plan for is for recruiting and retention. So why do you want to be giving matches or profit sharing on severance pay for somebody who's already left your organization? It's important, though, to realize that severance pay is not necessarily their last check. So if they've terminated and you pay out their last remaining wages and they're in the accrued PTO, if PTO is part of that definition of compensation, you still have to match on that even though that person's terminated. So kind of watch for that. A lot of people think, well, they've terminated, so this last check, I don't need to match on, and that's not necessarily the case. So in most cases, I would say pretty much all cases, it should be deferred upon and it should have a match unless they've elected to go to 0 before that last check. Another thing we kind of find sometimes is the setup of new payroll codes. This can kind of trip you up. It's typically not material unless you started doing something like, you just started doing bonuses. But just watch for those little things, like group health insurance and how is that treated, or stock options, how is that treated? Because sometimes in the plan document, especially with stock compensation, I've seen it where the plan document does not exclude non-cash wages that get included into W-2. It's just strictly W-2 wages. So if you have something like group term life insurance where you get taxed on it, that's part of W-2 wages. You don't get the money for it, but that still counts as W-2 wages. And if your plan document does not exclude non-cash compensation, that's one of those things that you should be including. It kind of can trip you up pretty easily on that. Another thing is to do an annual payroll tie-out, and this just makes sure that the information that you're sending to your record keeper is inclusive of all the compensation that you've paid out. So if you do that sort of reconciliation back to your payroll and just making sure that whatever data dump that you're giving your provider is actually including all of the compensation that it should. The old saying, like garbage in, garbage out. If you send some stuff to your provider that's not correct, you're going to end up having issues with that. This is something, employee deferrals. So timeliness of deferrals. Oh, go ahead. Yep. 1 second.
On the life and disability, if an employer allows employees to choose whether it should be pre-tax or post-tax on their payroll deductions, how would you recommend, putting that in your contract or setup or in your plan document?
So the question is whether or not, or if we recommend putting disability compensation as part of the definition of compensation?
The employer allows the employees to choose whether they do it pre-tax or post-tax.
Pre-tax or post-tax. I think if it just go back to your definition of compensation, I think what I would recommend with my clients is to keep it as simple as you can. So maybe just exclude it altogether might be the easiest way to deal with any disability compensation. Would probably be the easiest. Most likely your employees are in a position at that point where they're probably not wanting to defer, and they could be, but I think the simpler that you can keep your definition of compensation and all your plan provisions, actually, the better off you're going to be. Does that answer your question? Okay. So on to slide 11. So employee deferrals and timeliness of those deferrals. So the timeliness requirement is on the employee deferrals, not necessarily on the employer, although you still need to fund your employer contributions in accordance with your plan document. But the employee portion is what the DOL, the IRS will get all kinds of excited over. So the requirement is that you do it as soon as it can be segregated from your assets. So if you're a small plan is a plan that it doesn't require an audit, so it's below whatever the threshold is. Brand new plan, I think it's 100. An ongoing plan, it's 120 participants at the beginning of the year. So you want to make sure that for a small plan, your requirement is 7 business days, no later than 7 business days. Doesn't matter what happened, you should have a backup person if you're on vacation, if you're going to be in extended leave of absence, somebody that can handle that for you. Now, for a large plan, which is a plan that requires an audit, it's a little bit one of those things they really won't tell you what's acceptable. They'll come in and look, and they might tell you some things late or not, and it may even vary by examiner, which is always fun. But basically, you can kind of look to when are you putting in your payroll tax deposits, for example. So if you can pay payroll and you can get all your tax deposits in, then why can't you get your employee contributions in at the same time? So you want to look at that timeliness. You want it to be, I would say, under 7 business days for sure, but kind of look at what is administratively realistic for you in your position. And, I've got other things on my plate and I don't have time is not an excuse that the DOL is going to accept. So you really need to look at putting a little bit of a priority on getting those contributions in timely for your participants. So what can happen with that is the DOL considers that to be a prohibited transaction. So basically, you're taking your employee's money, you're withholding it from the payroll, and in their opinion, you're using it almost like as a loan, and you're using it for other operating and cash flow expenditures as opposed to putting it into their account. So that's a big, big no-no. And what happened there on the very last bullet point there with the prohibited transaction, what it requires is the corporation to pay excise tax on that, to file a Form 5330. And there's also a question on the Form 5500 that you have to check if you have late deposits, and you have to put that amount in there. It will also be reported in the audit opinion, or in the audit report. It's supplemental schedule. So this is a good way of kind of a red flag. It's kind of low-hanging fruit, really, for the DOL or the IRS to take a look at and decide to come and, show up and make a little visit for you. The employer, it just depends on what your plan document says. So some employers match on a pay period basis. Some employers just match at the end of the year. Defined benefit plans are typically the date of the corporate return filing. They can make a decision up to that, sort of what their policy is at that point. Money purchase plans, 8.5 months after plan year end. So eligibility is another place where we see some issues occasionally, improper exclusion or inclusion of employees. There are some minimum requirements that you have to have, so age 21 and 1 year of service. So you can't make people wait until they turn 26 or 27, like health insurance, or just make some other unreasonable years of service requirements for them to be able to participate in your plan. You can exclude certain classes of employees. I have plans that exclude union employees, for example, and that's acceptable, or foreign, employees that aren't citizens that are over, from a corporate location that's overseas or something like that, that you can exclude. Watch your entry dates. You need to be timely on that, and making sure that you're identifying those people who are eligible and giving them the opportunity to participate timely. Effective date of plan can also be an issue. We're in a situation where there's a lot of mergers and acquisitions going on. Have you amended your plan to let those employees in? Are you doing, allowing prior service credit for purposes of eligibility? Just make sure that you look for some of those little traps. Controlled groups or affiliated groups are another situation. If they don't have another plan that's comparable, you may need to consider whether or not you need to include those employees into your plan as well. So more on eligibility. So rehires, this is something that trips up a lot of my clients. So if you have a lot of turnover or seasonal employees that are kind of coming and going, contract type employees, this can be an issue just in tracking their service, because once you've met eligibility and you terminate, or if you're seasonal and you come back within a certain period, depending on what your break in service is, a lot of times you should be immediately eligible if you meet those break in service requirements. And it gets very complicated to track, especially if you're a larger organization. And so you want to watch out for that. Part-time employees is another one. You can't just automatically exclude part-time employees because they're part-time. If they meet the hours requirement, even though they're part-time, you have to allow them the option to participate in your plan. Communication is another thing, just letting employees know that they're eligible. I mean, sometimes, we get in and you're trying to confirm with employees that they've opted out and they have no idea that there was even a plan. So you need to make sure that those communications are happening, and you'll probably still get some employees who are confused and not quite sure what you're talking about, but as long as you have documents to show that you put it out in an employee newsletter or emails, or you've held enrollment meetings, that type of thing that shows that your employees at least should have had the knowledge. I mean, we always recommend that you get waivers. If somebody doesn't want to participate, it's the easiest way for you to show that, yes, they've signed off that they did not want to participate. So that's always good to do. Sure.
Okay, because we do have quite a few rehires. We have the auto enrollment.
Okay.
After 1 year, but if they've been gone, they would still have the 1 year waiting period. We should still follow that, even if they are a rehire.
Not necessarily. You'd have to look at what your break-in service requirements are for that. So if they were previously eligible for your plan and they terminated, it's typically with a 5-year. You may need to look at your plan document and make sure that you're letting them back in immediately. Alex, Alex, you need to look at that. Look at those rehires. But yeah, we can get with you after, and we'll make sure that we can look at those sections of your plan document.
Yeah, but that would be very hard to monitor.
It is very difficult. I have a client that does sort of temp to hire, and they have people coming in and out on contract all the time, and they may terminate 5 times during the year, but if the total of all that service adds up to them being eligible and they come back, they need to be put in the plan. It's very complicated to catch. Immediately eligible with no service requirements is always the easiest to make sure that you capture those. What was that?
Repeat that.
if you have people be immediately eligible with no service requirement, just date of hire is the easiest. Now, not everybody wants to do that because if you're funding a match or if your match eligibility requirement is different than the employee, that gets a little bit more complicated. But it's just one thing to look at. If you have a lot of people coming and going, that might make it
Thank you.
a little easier. Sorry about that. Always fun. Especially with a larger organization, it gets very complicated to follow that. So I think we are back to Kara.
So now we're going to talk about some areas in the distribution where we find a lot of errors. First one is incorrect vested amount distributed. So particularly like when you have rehires, usually you vest over a certain amount of time. So if, say you have a plan that vests over 20% each year, in 5 years you're fully vested. If you are not have the correct either hire date or the correct term date, you may have the wrong percentage that they're vested. And you could either pay out too much to the participant or you could pay out too little to them. So you need to make sure that that data is correct so that you're paying out the correct vested amount in your distribution. So if they're not vested, then that amount's going to be forfeited. It's going to go back into the plan. Lack of appropriate documentation. When we go in and do our audits, this is another area we're going to find either there's no documentation on the hire date, term date. It could be birth date. So if you're hitting retirement age, you need to make sure that they've hit that retirement age, some kind of documentation on that. 59.5, sometimes plans will let you take out an in-service distribution at 59.5. You need to make sure we know that correct birth date, documentation in their personnel files. Hardship withdrawals, that's another area where you need the documentation. You need to at least see it. You don't have to keep it, but you need to at least see it so that your plan will say what specific reasons you can take out a hardship withdrawal. So you want to make sure that you're getting that documentation, that they're meeting those eligible reasons for getting a hardship withdrawal.
And hardships can be very complicated because employees might think that they have a hardship, and what's a hardship to them and what's a hardship under IRS is very, very different, and it can be very confusing. And a lot of plans will have participants self-certify online, and I think that's a danger because employees don't understand. They think if I just needed a little extra money to, buy groceries or my kids going to college, that's not a hardship. Go ahead, Valerie.
This is on the hardships. I've been reading some information on hardships that they're going to eliminate that you can't contribute for 6 months when you have a hardship.
They looked at that with a new tax law, but I don't know if that ended up in the final. I don't think it did. And no, it may be. I know there's another tax bill that's working its way through. I'm not sure if maybe that provision is in there. I have not looked into that yet.
Okay.
I mean, it would be good.
Top of that one.
Yeah, no, it would be good because, you're just prolonging the time period where that person's able to, contribute again.
Right.
And it's hard to track.
It is. I just zero them out, and when they want to start contributing after the 6 months, I have them sign another form.
Yeah, that's probably best.
Yeah.
But then you have to make sure that you remember that 6 months later.
That's up to them.
Yeah. And it is. A lot of times in the plan document, it is up to the employee, but just realize that your employees probably don't know the rules. So, just as a benefit to your employees, if you can try to remind them.
For all that with them when they turn in one, and also provide the backup for the hardship.
Good.
So.
And you don't, like Kara said, you don't necessarily need to keep the documentation for that. I think the rules have changed a little bit where you just have to understand the nature of it, which I don't know how you're supposed to do without having something. I mean, I guess if you know that they're going through cancer treatments or something like that, maybe, the amount's not completely unreasonable, maybe that's enough. But maybe you need to make some notes in their file just yourself because I don't know how this works with HIPAA rules. I'm not a healthcare person, but I think sometimes with medical it can get maybe a little bit even tricky on that.
We'd rather be safe than sorry, so we do ask for documentation and bills to equal what they're taking.
Okay. I don't think that's necessarily the requirement anymore, but...
I don't want to get in trouble.
Yeah. Yeah, Alex is tough, man.
And another thing, I don't know if you're going to mention this about, most plans now, 401k plans are profit-sharing plans. But years ago, dating myself, profit-sharing plans, you could only put in up to 15%. So most plans, if they wanted to maximize that 25%, would have a profit-sharing plan and a money purchase plan. And those money purchase plans were closed out when the profit-sharing contribution went to 25%. The problem is on distributions, if you have old money purchase dollars in those plans, you are required to get a spousal consent on that distribution. If you don't, then, and you make that distribution, the spouse can actually come back in and say, thank you very much, but you owe me an annuity. So it's really important, and I think that's, something that kind of gets lost, and we've run into that issue in plans before.
Defined benefit pension plans, you have to look out for that too. 401ks typically don't have a spousal requirement, but
if they have
definitely
an old money purchase plan rolled into that 401k plan, then you've got to get a spousal consent.
So another area is taxes. So when you get your distribution and you fill out your form, make your elections, you have options. You can either elect to roll it into an IRA, in which case there's no tax required, or you can sometimes have an option saying, I don't want to have any taxes withheld. Otherwise, it is taxable, and you need to make sure that those taxes are being withheld if it is a taxable event. In-service withdrawals, when the plan doesn't, again, look at your plan document. What are your features? You can't let them take money just to take money. It has to be allowed in your plan document. We talked about the 401k deferrals not being suspended after hardship withdrawal. I think the minimum is 6 months that you have to stop the deferral on anyone that takes a hardship withdrawal. Some hardship distributions, if you allow loans in the plan, they are going to require you to take out a loan first, because that hardship withdrawal is going to be taxable, and so they want you to go ahead and try to get a loan out first before going into a hardship withdrawal. So you need to make sure that they're doing the loan option first. And then Lucy talked about the spousal consent.
You're just ahead of the game, Lucy.
So forfeitures, as I described before, is when you have distribution, it's employer money that is not fully vested, then it stays in the plan, it goes into forfeitures. And there's really 3 areas where you can use your forfeitures, and it all, again, is dependent on what your plan document says. You can use it to pay plan expenses. You can use it to reduce a future employer contribution, or you can allocate it to participants. So at the end of the year, you've got forfeitures of $10,000. You can just allocate it on some kind of reasonable, allocation method to all the participants. The thing you want to watch out, though, you need to use your forfeitures every year. That forfeiture balance should go to 0 at some time during the year. And I have seen some IRS audits where that was actually a comment that they did not zero out their forfeitures during the year.
And the situation there is that the employer is getting a deduction for that. So if they're over-contributing for whatever reason, over-contributing that to that plan, and that money is sitting there just held in the plan, the IRS wants their chunk. They want you to either use it or distribute it back out of the plan. Typically, you would want to use it within the plan, and then that requires less contributions going into the plan, and then they're getting their tax money. All comes down to that.
Yeah. Participant loans, you should have some type of formal loan program. It can be in the plan document, or it can be a separate document that describes the participant loans. It should describe the plan terms, which typically is 5 years, unless you have a residence that you're going to borrow to buy your primary residence. It should be amortized equal over the life of the loan. It should be enforceable, so you're going to have the participants sign it. There are dollar limits, and typically it's $50,000 or 50% of your vested balance. Sometimes it's limited to Like if you have another loan out, if you have multiple loans allowed in your plan, you have to reduce the amount of that other loan before you can find out your dollar amount. And then loans in default. So anytime you have a loan, a participant, your employee has a loan, they terminate employment, and they've not paid off that loan yet. That typically your payments are coming through payroll. So once they have no payroll, they have no payments on their loan. And if you go so long, usually the plan document will say, but like most of them like 3 months, without any payment on your loan, it's going to go into default. And then what you should be happening is that it gets a deemed distribution. So what they're going to say is instead of you have to pay that loan back, we're going to say you just took that money and we're going to treat it as a distribution to you. You're going to get a 1099 for that amount. Now, you do have to, there are some rules too about tracking that, and if they ever wanted to come back and pay off that loan, and you do still have to kind of keep records of that.
I'm always a big fan of just don't put loans in your plan for a variety of reasons. It's complicated. I mean, it really is. It's complicated. And a lot of employers, I mean, I have some plan sponsors who really are think that they're doing the right thing for the employees by allowing loans in the plan. And really, it gets complicated because participants don't realize this, that they quit. I mean, how many of your employees have the money to put that $10,000 right back into the plan within a few months after terminating and starting a new job or moving or whatever possible hardship even maybe required them to terminate? And so what happens is there's huge tax penalties. It's going to set them back in retirement. Even just taking a loan from the plan, I mean, we call it like plan leakage. And there's been a lot of discussions as to, funds leaking out of retirement plans and how can we keep that from happening in this, I mean, a lot of people just aren't saving as much as they should anyway, and then you're letting them take money out of the plan. So it's complicated for a variety of reasons, and I think in a lot of times it ends up hurting your employees more than it ends up helping them.
So allocations to participant accounts, Nancy had talked a little bit about this, about the compensation and the data that's being used to figure out these allocations, particularly if you've got like a profit share contribution that's going to be allocated to all employees, whether they participate or not. If your data is not accurate, particularly compensation, hours, active status, then you're going to have a wrong allocation. So you're going to have employees that either are not getting enough of the allocation or got some when they really shouldn't. Say the hours were wrong. So they really weren't eligible based on the hours, but for some reason, whoever started their payroll just, treated them like they were salaried, but they weren't. Some of them, sometimes the plans will say that they have to be employed at the end of the year in order to get an allocation. Well, if that census information is not including your hire date, then they're not going to know that they've terminated and should not be getting an allocation at the end of the year. Nancy also talked about, match calculations could be put into the plan on a payroll basis or can be at an annual basis. And then the other thing is the investment election. So your participants are going to decide where they want their money. So you need to make sure that wherever they have selected to have their money, that's where their money is going, into those correct investment elections.
And a lot of that is now done online, but what you want to be doing is looking at your participant level reports and making sure that the totals there agree to your trust report, because what can happen sometimes is like the record keeper is not really sure what to do with the money, so they're just going to hold it and it'll be in some type of a suspense account. And in that case, it's not being invested in accordance with the participant's election, so you need to kind of watch out for that. Some record keepers are better than others about identifying those and following up, but some of those bigger companies they just think it's your responsibility. They've got the money and they're just going to wait until you tell them what to do with it.
So plan expenses. This is the area, when we talked about lawsuits, this is the area where you're going to find the lawsuits usually come into play. The plan administrator or plan sponsor is going to have a responsibility to make sure that those expenses are reasonable. And one of the ways you can do that is to benchmark them with other plans that are similar in size. There's information on the internet, there's services that can provide that to you, but you need to make sure that you're benchmarking them Sometimes your investment advisor can help you with that. They might be the ones benchmarking those investments and making sure that those expenses are reasonable, your investments are reasonable, and document that. So that if they were to come in and audit you, you've got documentation that, yes, you have done something to determine those are reasonable. Doesn't mean they have to be the lowest. Doesn't mean, that if they're high, it's wrong either. It's just what's right for your plan and your participants. And there's also required disclosures. So,
Is there a time frame that you recommend that groups do the benchmarking, or should they do that every year, or is
I would at least
years?
annually do it.
Annually?
Mm-hmm.
And if you haven't had your plan fees looked at in several years, this would be a good time to do it, because there's been a lot of pressure on the industry, not only an investment advisor piece, but on your record keepers to keep fees very low. So if you've had a plan in place for many, many years and you've never renegotiated those fees, it is well past time to do so.
So a couple years ago, they wanted full disclosure. So they required the plan administrators to disclose to participants what expenses are being paid by the plan, what the investment expenses, by investment are, and they have to be given to the employees. There's certain manners. You can mail it or post it somewhere where it's accessible to everybody, but there's also a timing where you have to have it done by a certain time of the year.
I think there is some, along with that, some efforts to make it easier for TPAs to do that electronically. But you do need to make sure that all your employees have reasonable access to internet, whether it's in a shared space or in their job that they're using, that they're on the computer all the time, because they need to be able to have access to that. But it can be pretty costly if you're doing it all by paper. So I know there's a lot of efforts in trying to figure out how everybody can make this a lot more electronic in the days that we live in. So annual testing, and then we talked a little bit about, I think we can't harp enough about making sure that your providers have the accurate information here. So the annual testing is different than what might be required for your audit. So every plan needs to go through non-discrimination testing, and there's various testing types of tests that has to go through depending on your type of plan, is to make sure that it's just operating in accordance with, it's not being discriminatory and not giving a much higher benefit to the highly compensated. It's usually the highly compensated employees that they're worried about, skewing that plan in favor of those who are already highly compensated. But we've come across an issue where testing hadn't been done at all. And so that's a big oops on your provider, but also an oops on you as the fiduciary for your plan. Making sure that testing is being done, because if it's not, and you have to go back through years, you're talking a lot of expenses. You're probably going through a type of a program, and you're going to have fees with that, and you're going to have attorney fees, and it may require re-auditing. It may require huge excess contributions to your employees. And when they have to go back and file many years of amended returns, they're probably not going to be very happy with you on that. And so it can cause a lot of problems for you. It can cause potentially, I suppose, tax consequences for the plan, although they're probably less likely to do that since it hurts the employees more so than it would hurt the corporation. But they can get fined up to, I don't even know if there's limits on that as to what can be assessed with that. So you just want to make sure that that testing is being done. And part of that really is just doing, the vendor management and doing your due diligence on who is taking care of your plan. You can't expect yourself to just be a retirement plan expert. I'm sure you're juggling, 50 other duties on any given, hour. And part of that is taking care of the plan, but you need to make sure that you're doing your due diligence on your providers. Who's your trustee, and are they knowledgeable about the plan? Who's your record keeper? Are they well known? Are they well respected in the industry? To make sure that you have those checks in place and you have people, outside providers, helping you to make sure that your plan is operating, the way that it should be. Defining highly compensated people and just making sure that, again, that your census data is accurate so that those people are getting picked up as being highly compensated, so your testing results are correct. Different types of testing, we won't really go into what all of these are just in the interest of time, but there's very different testing depending on whether you have a safe harbor plan or not, as to whether your plan is exempt from some of this testing. But again, you're basically just making sure that your highly compensated aren't taking the lion's share of the benefit of the plan. So a lot of times we'll see where you have a couple select very highly compensated people, and you have a lot of very low level, low salaries. And this is usually when your plan gets a little out of balance. It's not like you're trying to do anything wrong, but when you have a bunch of highly compensated who want to max out their deferrals, and you have a bunch of lower compensated employees who either aren't contributing or they're contributing at a very low level, or a low percentage of people contributing, this is usually where you end up out of balance. And this is something where your provider can assist you. There's different types of plans set up that you can do to make sure that your highly compensated can take full advantage of participating in the plan. So what ends up happening is that if you don't make any sort of safe harbor modifications, is your highly compensated want to max out their contributions, but they're not able to. So they fail the testing because not enough of your non-highly compensated are contributing. So what ends up happening is they get refunds back out of the plan. Well, I mean, that's no fun. You're losing part of your tax benefit, right? You're losing part of your match. It just causes issues with your recruiting and retention, for example. You want those more highly compensated to be able to fully participate in your plan. So there's different things that you can do if you're in a situation like that. A lot of times you can do a safe harbor plan where you just automatically are giving a contribution. I mean, I have a plan where the employees don't even have to be participating; they just get a certain amount of money just put into the plan. It can get a little bit more expensive, but it depends on, I think, what you're trying to do with your plan and what your intent is. Even if you're wanting those highly compensated to fully participate, then you need to look at what options you have and the most cost-effective ways that you can do that for your participants. One thing that can happen too if you fail testing is they can recharacterize some of your catch-up contributions and make those, or recharacterize some of your contributions as catch-up contributions to get you through and pass some of the testing too. So there's different ways that they can kind of look at your data. So again, you want to make sure that your data that you're giving your record keeper is accurate. The Form 5500, so late or incomplete returns or no return filed. So it used to be that this was done paper, and we would have clients who, they weren't getting their audit done, and, you just kind of waited, and then they would, they would file the return timely, but didn't have the audit attached. Well, that's an incomplete filing. And back in the day, it was always paper, and it took however long to get wherever it needed to go and get processed before anybody even realized it was incomplete filing. And then you usually just got a letter saying, hey, forgot to attach your report, and they didn't really notice that our audit report wasn't dated till a month or two after when it probably should have been. Now everything's electronic though, so it kicks back pretty quick. So if your filing is incomplete or if you don't file, they're going to know, that system is going to know immediately that that filing was incorrect or has not been completed. And the penalties can be pretty stiff. So your deadline is 7 months after your plan year ends. So of course, with a calendar year end, that's 7/31. You can also file an extension, so it's a Form 5558, and if you file that extension, you get an additional 2.5 months. So that'll bring you to October 15th, or 15th falls on the weekend. It's just like any other tax deadline. It bumps to the Monday. So you just want to make sure that you're aware of those time frames. I wouldn't recommend waiting until the last day just in case something goes wrong with the system. It could crash. I mean, it is the government we're talking about, right? So, I mean, in the last few days, there are a lot of filings that are happening all at once, and it can cause some hiccups in the system. And to the IRS, it's just like any other government agency. They don't care. Like, you should have done it 2 months ago. They're not going to have sympathy that you were the one on the last day that the computer crashed and you couldn't get your filing done. So it's required to be electronically filed now. So that is something that you need to just make sure that you're ahead of the game. So you're not sitting there, the last one filing and doing that. So just kind of keep in mind what those deadlines are and making sure that your filing is complete. And like I said, if you are over that threshold for an audit, you're going to need to have that audit done as well. And we've had a couple situations where, and unfortunately, the TPA wasn't paying enough attention either. And what happened is they're coming up on October 15th, and oops, you're over the threshold, you need an audit. I mean, I had a call one year on October 15th saying, well, we're going to need an audit. I said, well, that's great, but not today. You're not getting it today. I mean, there's nothing I can do for you. We'll get it done as quickly as we can. And that filing's late, and they can be penalized for the failure to file properly, file completely. They can get penalized all the way back to July 31st. not from October 15th to the date they file, but it actually goes back to July 31st. So it can be pretty substantial. And so you just want to make sure that, that gets done. And, at some point they'll get a little nasty gram letter that says, hey, you've got 45 days, and it has to be in. And so you just need to be mindful of those deadlines. We talked a little bit about the audit requirement for the larger plans, and like I said, just being aware of what those requirements are. Hopefully your providers will be tracking that for you, but if you're in a mode where you're a small plan and you're growing and you're getting close to that, that's something that you need to be looking at, because the last thing you want is to be behind on getting your testing done, your information submitted, and then you're the one sitting there in October going, oh gosh, I should have had an audit for last year, and now what do I do? I'm going to be late. There's no way you're going to get it done. And so you want to keep that in mind if you're in an organization that's growing, that audit requirement could trip you up. Health and welfare plans, of course, there's 5,500 filings required with those, and depending on how it's set up or not is dependent upon whether you need an audit for those. Most don't, for the most part, I think. I think we've had a couple that have, and we've been able to get them to kind of convert those into a format where they don't need to have an audit. So, but again, there can be some stiff fines and penalties, not to mention you just don't want to invite them in. Just don't give them any excuse to come in for a visit. So we're all human, and we're going to make mistakes. Things happen. Somebody gets entered incorrectly. They don't get the match that they should. Things happen with your plan. And so it's important that you're monitoring it and you can catch those issues. And then there's various different ways that you can correct those. Minor things can probably just be fixed yourself through some sort of self-correction. If you do have a late deposit, you can go ahead and bring those people, get it in as soon as you catch that for whatever reason you've missed that deposit. You can go ahead and calculate earnings and get that remitted as quickly as you can. The worst thing that you could do is just, oh yeah, we're just going to catch me if you can. Because if you do get caught on that, that's obviously going to be a problem. So you want to make sure that you're, if you do, you do come across a problem, that you're the one that's dealing with it. Because the last thing you want, like Kara said, is for the DOL or somebody to come in and they're the one catching it, not you. They're a lot more sympathetic when you raise your hand and say, you know what, we messed up, and we're going to try to do what's right and fix it. And so depending on the severity, there are different programs that you can go through, and we won't go into detail on those, but it may require an ERISA attorney to kind of walk you through the process, depending on what it is. The good thing about a lot of these programs is when you go through one of the pre-approved programs and you say, okay, here's all the things that are wrong. And it's usually for larger items, like you've been excluding bonuses since inception of the plan, and it's been 20 years, and you're looking at probably hundreds of thousands of dollars. And how do you legitimately, what time frame do you go back, and how do you find all those people that worked for you 10, 15 years ago? You're probably going to want to look at one of the programs and go through, and then they can kind of help you with, between your attorney and any conversations with the DOL to say, okay, this is what you need to do. And they're probably not going to make you go back to inception of the plan and fix every little problem. But at that point, you want to fess up to everything that you know was wrong in the plan, get it all into the plan, into the correction program, and get it figured out. And what that does is they'll come back and tell you what needs to be done for that to correct it and bring your plan back into compliance. And then you're blessed. They can't come back a year later and audit you and say, well, but you didn't fix this year. It's like, no, you told me I didn't have to. So you kind of get a pass at that point. So it's expensive, but there are situations where that's just what's required and what you're going to have to do to fix that. So. Again, self-correction, we talked a little bit about that. And even if you aren't required to have an audit, it's not a bad idea to have, whether it's your internal auditors or, whether it's somebody like Kraft who can come in and just do some procedures for you, whether that's a full-blown audit or most likely just some agreed-upon procedures. Just check a few of the low-hanging fruit, if you will, some things that are just easy to go wrong. Another thing, when we talked about the plan growing and when you end up in an audit requirement, what also happens is with your employee contributions, you used to have a 7-business-day safe harbor as a small plan. Well, the minute you've tripped over that larger participant threshold and you become a large plan, even if you didn't know that you were a large plan, you no longer have that safe harbor. So that's something that we see too in plans that are growing and trip over that threshold. So you need to be just looking and trying to figure out what you should be doing and when, and, conversations with your auditor, conversations with your TPA, are very important, and just making sure that you have, providers who are experienced in this area, because it is difficult, and I'm sure you have more than just a plan on your plate, right? I mean, it's a tough thing to keep up on, and, but there can be severe consequences. So I think that's all we have. If you have any questions, I know we've got about 5 minutes left in the presentation, but I've got extra time if anybody has any questions.
I have had a couple of bizarre instances in the last year that, thanks. I had a couple of bizarre instances in the last year that have happened. Our group was formed over 20 years ago through a merger of two preceding groups, and the IRS has actually sent letters to two different people who were employees of one of those groups back then, like we're talking like 1995, and said you could be eligible for some sort of funds from this retirement plan. And here it is, over 20 years later, and why are these letters even going out? And then there's some kind of statute on that or limitations.
Wow, I have to see that. I'm not sure that they would think that there is a statute of limitations on that.
So is that like a lost participant situation? Like they left that plan and they couldn't find them, and now they're kind of finding where these people are, say, hey, you have money over here?
They said you could have money.
Okay, so they said that you could have money, not necessarily they did. Were they participants in the plan? Did they have any money in the plan? They had money back then. Was the money still sitting there? They had long since. You couldn't find any records. Yeah, because lost participants is a big thing, and we hadn't really talked about that. But this, I'm not sure, unless maybe somebody complained, and so they're looking into that.
They were shocked that they got this letter.
Yeah, that's kind of crazy, because usually they don't go hunting for people. Lost participants is obviously a big problem, because if they had money in the plan from way back when and you've lost track, that gets very hard for you as an employer to find them. So you've dealt with that, Valerie?
Yeah, terminated employee that's been gone for 8 years, thought she had money in the plan. She's got a statement somewhere. We did a cleanup last year, I think, small balances and stuff, and which got possibly put into an IRA. So I'm giving her all the phone numbers I've got. But that's really all I know to do.
Yeah, and that is difficult. We didn't talk about where you can force out people. If they're less than $1,000, you can automatically cash them out. If your plan allows it between the $1,000 and $5,000, you can roll them to an IRA. The problem with that, and we have some bankers here, but banks have regulations to follow too, where they have to know their customer, and they have to know the identity and prove the identity of the customer. So I would almost think a bank would be a little hesitant to open up an account for an individual that nobody has a record of where they are. Do you have anything to speak on that? I mean, I know you're a loan officer and you're not necessarily opening accounts, but do you have any insight onto how a bank would handle that?
No, I don't, but I can imagine that they would be okay with that.
No, I mean, because banks are obviously very highly regulated, and with their, especially after 9/11 and all the regulations that have come into play, I don't even know what you do. And I mean, there's services that can help to find these people and find their money, but it's expensive too.
And I give them this number, and Newport did provide me a phone number when we did this that I could give to employees. So I do that, but it's difficult.
It is.
I can't believe people leave their money. I always tell them, put your money all in one place so you'll know where it's at. If something happens, your family knows where it's at. Because now she's looking, and I got a statement somewhere, so I hope she finds it.
Yeah, oh, definitely. No, because that can be tricky. And, as people are more mobile and definitely not staying with, with companies for 30, 40 years, like was a lot more common several decades ago.
We try to catch them before they leave.
Yep, try to catch them. Mm-hmm. Yep, try to educate them. And that's about all that you can do, and just say, hey, if you're not taking your money out, you need to let us know, when you change address, or let the provider know. Yeah.
I encourage them to, roll it into an IRA, but, you have options at that
Sure.
time.
Yep.
Because it's more easily accessible.
Yep. And you have options where it's still non-taxable, where you can put
Right.
it into a qualified plan or another
Right.
type of account.
Yeah, so I very much encourage them
Yep.
to move it.
Yep.
It's easier for you to do it now than later. It'll be
Sure.
local if you need it and,
Yep.
and all that, so.
Yeah, definitely. And it gets hard for the employer because if you lose track of them and the provider loses track, now you have this money in the plan that,
Yeah,
you
if
know.
we were doing the cleanup, you know, you're
Yep.
trying to find all these addresses, 'cause they don't call and tell
Sure.
you.
No, and if they're not updating you or they're not updating the
No.
provider as to where they've moved, the IRS doesn't help anymore either. It used to be, you know, I guess when I first started working, you know, you could call the IRS and say, hey, I've got this person I can't find, and the IRS is more than happy to help you find them because they're hoping that they get a little tax, you know, a little tax money out of the deal. I think they just don't have the time for that, and they haven't done that now for years where they'll help. But they also don't want you to sheet it to the state. And so what are you supposed to do with this money? And now you're, you know, there's plan expenses that come into play with holding this money, and usually it's smaller balances typically. And it's a lot of extra record keeping fees that you're having to pay. Or they're calling you saying, I don't know what happened to my money.
Yes, yes. When we eliminated the 401A and
Sure.
it made me feel better. There were people that'd been gone for years that had a lot of money.
Yep.
And I'm like, are they still alive? You know, there's this money here.
Yep.
And so a lot of people were found and they did something at that time.
Sure. Yeah, that's
So.
the
but I
benefit
just
of
wondered,
doing that.
yeah, she has been gone 15 years. Why is this? I mean,
Sure.
over 100,000.
Yep. And it could be that the person passes away and their family doesn't know that they have it.
Yes, yes. That's why we try to catch them when they leave.
Yeah, and especially if you're getting electronic disclosures and, you know, now your provider should be doing, I mean, hopefully maybe is doing some death checks and running Social Security numbers against, a database to see if, you know, Social Security, just to see if they're deceased. That can help with that and identifying and helping the states to identify where there's, you know, lost money. But there are services that can do it. I have a client that has a lot of turnover, and at one point, a lot of seasonal workers, at one point they did profit sharing. They'll never make that mistake again. So now they have a bunch of just little accounts, because when you do profit sharing, you have to give it to everybody, even if they're not participating in the plan. So they had, I mean, hundreds of accounts with less than $100 that they were having to try to track these people, and there's still a bunch of that money sitting in the plan that, you know, what do you do with it? And you can't find them, and, you know, they try to ask everybody that's currently employed, hey, do you have contacts for any of these people? They tried to look them up on Facebook. They tried to Google them. You know, what do you do? And it would be crazy expensive to go hire somebody. Yeah. You got my, I mean, it is. I mean, they're trying everything that they can because it's still your responsibility to try to find these people, and it can be quite a hardship on the employer.
Fill out that 89, 55, whatever form it is, essay, to basically tell the IRS who still has money in the plan, even if they've been terminated. Is that like one of their tracking?
I think that's part of the Form 5500 filing. We typically don't see that because it has the Social Security numbers on it, the form that, I forget the form number.
Yeah, it goes with the 55.
8955.
I think that came out basically to help them track
Yeah.
people that are
Yeah.
still in the
Yeah, so that form is
have got
something,
money in the
yeah.
plan.
And the filing for that is a little bit different because the Form 5500s are public, so they've made it now so that obviously that form, you can't get that because there's Social Security numbers and everything attached to that. The problem is, I mean, like the IRS, they just don't have time. I mean, realistically, with some of the cutbacks, the personnel cutbacks and budgetary cutbacks, you know, I'm not sure what they're doing for it other than if somebody's calling them and saying, hey, you know, I have money.
Well, no, I'm just wondering if, because you were saying you got a letter from the IRS saying.
Well, no, these people got letters.
Oh, the people
Yeah, the old participants.
got letters from the IRS.
Yeah.
So I'm
Yeah,
wondering
that could be.
if that might have been a default of getting that filing.
Yeah.
That's possible. But you're saying that you couldn't find that they even had money in there or any records. Sorry. So I'm not sure. I mean, that could be. But it gets difficult.
Any other questions? We will be emailing out copies of the presentation, so I know everybody was taking notes, but you will get this PowerPoint. So, we'll send that to you by email. If you need continuing education credit, we've got forms for that. We appreciate your feedback. I think our next, healthcare helping will be, probably in the January timeframe, looking at, some of the upcoming changes to Medicare and how they may impact medical practices. So, yeah. So we appreciate you being here, and thank you, Nancy and Kara. And
Thanks for organizing, listening. Thanks for everybody who braved the traffic this morning.
yeah, exactly. You get a